news that we got Ras Gas cutting the price at which it supplies gas to Petronet LNG and other Indian companies by half. And that would mean that further gas availability for gas-based power companies would also or could also fall. Is this a fresh piece of good news? Does it make them viable? For these questions, Harshvardhan Dole, the Vice President, Institutional Equities at IIFL, joins us. Morning, Harsh. Happy New Year to you. That really is the first question. As LNG prices get cheaper, will domestic gas-based power companies find themselves viable?
Well, thanks for New Year wishes, and I sincerely wish you all the same. Well, gas has been one of the weakest links in the power sector for India for a while now, and for but obvious reasons that the cheap APM gas supplies have dwindled down, and we have to rely more on the unpredictable, volatile LNG. I think there is a short-term window available here, maybe for next 3 to 4 years, which will create a scenario whereby the global LNG prices will remain weak and perhaps offer an opportunity for the gas-based power plants to operate at more than 60-65% PLFs. And the reason why I say so is if you look at the total capacity of 23,000 megawatt installed capacity, 14 to 15,000 megawatt rests with companies such as NTPC and the state power sector utilities. These have signed definite PPAs which are coming with take or pay obligations. So regardless of the actual generation, these companies continue to recover their fixed costs. And now, at a time when the LNG prices are much more competitive and likely to be so, their generation outlook will definitely be much better than what it is today. Well, to me, these companies will definitely generate more, and their PLFs will definitely go up. Earnings, however, I'm not so sure, for the reason these are take or pay contracts, and their earnings will actually remain static regardless of the actual generation. There are a few power sector companies in the private side which could benefit out of this medium-term window which has opened up, naming say Torrent Power or selectively maybe a Lanco and so on and so forth. But these to me need to be viewed in the larger context of what is happening in the power sector, and whether these will be seen as trading bets or more of long-term opportunities to invest.
Okay, Harshvardhan, hi, good morning. Can we talk particularly about Petronet LNG and what the impact could be? Because I understand that, this Ras Gas deal could improve the utilization of the Dahej terminal quite a bit. You were talking about the increase in PLFs as well. And we do know that this Dahej terminal was facing issues for the last many quarters now. Going forward, what could the impact be, particularly on Petronet LNG?
Petronet LNG, their uncertainty over the offtake will certainly get eliminated. That's number one. The terminal will start operating not only at nameplate capacity, which is 10 million ton, but the way they have been operating terminal, there is a good chance that the utilization may even exceed about 120 to 125%, at least till the time new capacity comes in. And third, most importantly, because of lower offtake of this long-term contract, they had been facing under-recovery on the shipping cost, which was estimated to be anywhere between 100 to about 150 crores. So that now gets eliminated. And to that extent, the earnings in FY17 could get restricted upwards by about 8 to 10%. In long term, if the gas prices remain weak, essentially the terminal offtake will only be closer to the nameplate capacity even after the expansion is through. So the benefits are actually threefold. The uncertainty over offtake goes away. So that is more of a PE re-rating event. Secondly, the under-recovery on the shipping cost goes away. So that is an EPS impact. And thirdly, because of the higher utilization, probably the plant could derive more operational synergies, thereby leading to further EPS upgrades.
Okay. Harsh, the gas-based power plants which could be advantaged would be RE Power, Lanco, GVK, GMR, JSW Energy. In what order would you have buys in any of them?
Well, I'm not sure whether JSW Energy has any gas-based power plant. Amongst the rest names that you have put forth, we officially do not have any recommendation on Lanco or even Reliance Power. But as we understand, Reliance Power is in a process of moving out its plants from India to Bangladesh. And this is the Samalkot unit, which is probably the largest gas-based power plant ever built by our power so far. And incrementally, this particular news flow may not greatly benefit or impact negatively to our power. I think significant benefits could come to Torrent Power because it has got some untied gas-based capacity, particularly on the DGen side. And if gas prices remain weak for the next foreseeable period of time, I think the that offsets the uncertainty associated with the power generated from that unit. I'm unable to quantify the benefit for the reason they'll have to sign either a short-term or a medium-term PPA. But certainly that is one stock which amongst the private sector should see some benefits.
No benefit at all for GMR GVK or Lanco.
I think for the other private sector companies, the problem is beyond gas. Gas, is probably less than 10 to 15% of the overall balance sheet exposure for these companies. At the margin, certainly it is positive, but the market is really worried on the 88 to 85% capital which is being allocated to assets other than gas, i.e., essentially coal-based power plants.
All right, Harsh, we leave it at that. Thanks so much for joining.